Good morning. My name is Miguel Gonzalez, and I'm a certified retirement counselor with over 20 years of experience helping clients in retirement income planning, overseeing investment of funds, and designing retirement plans. Big swings in the stock markets can hurt your retirement savings, but there may be ways for you to stay on track to meet your goals. A recent survey from MetLife found that nearly 70% of plan sponsors who offer retirement plans, such as 401ks, were concerned about participants' abilities to weather market volatility. 61% of sponsors were worried about participants who were already retired. Although the stock market has generally climbed higher in the past 2 years, negative returns plagued the market in 2022. If this happens, it's important not to panic and initiate a sell-off, according to Rob Williams, Managing Director of Financial Planning at Charles Schwab. Doing so could result in missing out on investment gains once the market recovers. Keep in mind, a cushion of savings can help avoid panic. In order to avoid a panic sell-off, experts recommend that current retirees have between 3 and 5 years worth of living expenses in cash, cash equivalents, and short-term investments. That lines up with how the stock market behaves. According to Schwab research from 1960s to 2021, it has, on average, taken around 3.5 years for a diversified index of stocks to recover after a downturn. Retirees should have what we call a war chest of cash and bonds that would allow them to fund their living expenses from somewhere between 2 and 5 years, says Taylor Schultz, a CFP and founder of Define Financial. I know that's a big range, but it kind of depends on how much risk the client wants to take. William recommends retirees set aside a year's worth of expenses in cash and cash equivalents like a money market fund or high yield savings accounts for the more immediate needs. Additionally, he recommends having 2 to 4 years worth of expenses in short-term investments like short-term bonds, short-term bond mutual funds, exchange traded funds, or even a CD ladder. If you're not retired yet, though, you still have time on your side. And according to the MetLife survey, only 40% of sponsors were concerned about participants who were more than 10 years out from retirement. That risk of a sudden drop in the market, if you're very heavily invested in stocks, is much riskier when you're close or even early years of retirement than if you're in your 30s or 60s, says Williams. So you can also benefit from a down market because you're putting money into your portfolio and you're buying into the market at lower prices. So which assets should you tap first? And in an emergency, retirees who do not have short-term savings may have no other option but to tap their investment accounts. If they do, Williams favors withdrawing interest or dividends income first. However, Schultz prefers to reinvest dividends whenever possible. He recommends focusing on building up that cash cushion over time. For example, if you wanted to build up your cash and short-term investments over the course of 18 months, Schultz suggests selling off some of your investments every quarter until you have the amount of cash and short-term savings that you were aiming for. Both Williams and Schultz strongly encourage retirees to periodically rebalance their portfolio based on their financial goals. If your portfolio becomes overrepresented or underrepresented in one asset class due to market volatility, you may consider buying or selling certain assets to return the portfolio to its target allocation. The market will tell you when to reposition that money, says Williams. If the stock market has gone up, you might buy more bonds. If the bond market has gone up, you may be tapping some of that to rebalance and go back to the stock market. Once again, this is Miguel Gonzalez with Cortburg Retirement Advisors. Please take a moment to click the like icon and don't forget to also subscribe to my YouTube channel to receive a weekly video podcast every Monday morning. Thank you for watching, and I will see you all next week.